In this example, we're going to use the same basic information about grant management consultants that we used in the previous example, but with a twist that the Swiss franc is what we are seeing here as far as the dollar amounts in the comparative balance sheets and then in the income statement and retained earnings statement. But we also have identified the functional currency as the Brazilian real and not the Swiss franc. The other example, the Swiss franc was the functional currency. So we have to take two steps when that is the case. We remeasure the statements into the functional currency, and then we translate the statements in the functional currency into US dollars. All right, here are the real per Swiss franc conversions for you. And so we're going to work with remeasuring the account balances and then, as I mentioned, translating them. Okay, and here are the dollars per real. So first we use this to get Swiss francs into reals, and then we take these amounts and translate the reals into the dollars, the US dollars. Okay, so what that looks like, they've run both of these together. You can do them separately as well. Here is the income statement from above again. When we translate, right, we'll use the average rates for the revenues and the operating expenses with the exception of depreciation. For depreciation, you're going to use the historical rate that matches up with the property purchases that this depreciation relates to. So as of the beginning of the period, you would use the 1.394. There weren't any changes in the property, plant, equipment account itself. So that's the assumption we can make here. Retained earnings beginning of the period, you use the January 1 rate. The dividends, you use the rate from the date where they were declared and paid. And then cash and receivables, you'll use the rate that is in effect at the end of the year, historical rate for property, plant, and equipment when we remeasure, right? And you notice up here for the depreciation, it was that same rate. So doing the multiplication across gives us a retained earnings at December 31st of 53,366. You have your assets remeasured for a total of 122,523. You have your accounts and notes payable and common stock remeasured, and then you drop the retained earnings number down here, right? And we've remeasured, so there isn't any translation amount to worry about in the balance sheet, where when we remeasure, we actually put that number up here as the difference that we need to make the retained earnings balance out, right? After we do that, right, we come up and take the translation rates and take the Brazilian currency and translate it into the US dollars. So average rates here, okay, remeasuring, you use a historical rate for depreciation. In the translation process, you just use the average rates. The retained earnings at the beginning of the period, you use the 1/1 historical rate. The dividends, you use the rate in effect as of that date, right? And that gives you retained earnings of 25,570, which you drop down here, right? For the cash and receivables, right? We are using the rate at the end of the period. Same with accounts and notes payable. Common stock, you use the beginning of the period historical rate here. So what you wind up with are total assets of 56,727, total liabilities and equity of 58,317. So now you have the translation adjustment coming in here as 1,590, right? And that will balance you out. So we can go ahead and prove these, right? And make sure that we understand where they're coming from. This problem will use the same information for grant management consultants that we used in the prior problem as far as their statements go. You still have the balance sheets for January 1 and December 31st of 2014. And then you have the income statement and change in retained earnings for the year ended December 31st, 2014. The difference here that I highlighted in yellow is that the functional currency of grant management consultants isn't the Swiss franc. In this case, it's the Brazilian real. So to get to the US dollar, we have to do two different things. We have to take the Swiss franc and convert it into Brazilian real, and then we have to take that statement and convert it into US dollars. So the process of getting information into the functional currency is called remeasurement. We'll use a couple of different measures, a historical as well as a current measure in this example, and then we'll take the remeasured numbers and translate them into US dollars. In chapter 14 of the text, this is around page 595, and they'll walk you through, and they've got some good examples in there where they identify the rate right on the balance sheets and income statements. So they'll use currency and then H for historical. So it's a good thing to look back at and also help you with this problem, right? So here are our real per Swiss franc numbers, okay? Beginning of the year, end of the year, average, and then as of the dividend payment date. So first we're going to remeasure the account balances, and then we're going to take those remeasured amounts and translate them using the real, dollars per real, and get it into the US dollars so we can include it in our consolidated financial statements that are stated in US dollars. Okay, this chart down here does both. So the first thing we're doing is taking the information that we used in the prior problem, same starting point, that are in Swiss francs. And now we're going to actually remeasure into the Brazilian real. So the rates that we're using to remeasure for the revenues and the other operating expenses will be the average rates. Depreciation will be remeasured using historical rate, and you'll see that the net property, plant, and equipment also uses the historical rate. For sake of this example, we'll assume that historical rate is the appropriately from the beginning of the period. The cash and receivables and accounts and notes payable will be measured using the end of the period rate. The common stock will be historical, and that's in both the remeasurement and translation, so only historical for common stock. Net property, plant, and equipment, as I said, is historical. And then the dividends are the actual, as of the actual date that the dividend was declared and paid. Okay, so if we are using different rates here in the income statement, it should make sense that there's a balancing amount that we need to include here to make sure that we're coming up with the appropriate figure for the retained earnings, and the impact of the remeasurement goes to the income statement. Okay, our translation goes to the other comprehensive income, goes right into the equity piece. So our retained earnings, 53,366, right, will be what we use down here for the remeasurement piece. There's no impact on the equity section directly, which would be the other comprehensive income part. It is, the impact is right here on the income statement. Right, after we get that piece done, we'll translate it. Translation, you use the average rate for everything on the income statement, so the 0.4751. Then the beginning retained earnings, you use the beginning of the period historical rate, the dividend, the rate that is in effect as of the date of the dividend, right? And that brings us down to 25,570 in US dollars for the retained earnings at the end of the period. We plug that in down here. We use our end of period rates for the assets on the balance sheet, the accounts and notes payable. For common stock, we use the historical beginning of the period rate. So when we do those computations, we have total assets of 56,727, total liabilities of 58,317. So in order to balance, we have a translation adjustment here that is a debit, it's a loss. Okay, so it reduces the equity section in order to make it balance. So hopefully that helps you to see what happens if the functional currency is different from the currency that the statements are prepared in.